Welcome back to the YouTube channel of J Finance, Berkshire's leading mortgage and insurance experts. In today's video, we're going to talk through what happens when your mortgage is coming up for renewal. That's when your existing rate is coming to the end of its period and you're going to drop onto the lender's SVR, that's standard variable rate, if you do nothing. So, what should you do and how should you go about it? Today I'm going to talk you through what we typically do with our clients at a mortgage review. So firstly, we'll look at when the deal is coming to an end. We usually want to be doing something within the last 3 to 6 months. Now, we make sure we contact all of our clients at about the 6-month mark, sometimes slightly after that, and then usually do something either then or at least within the last 3 months usually. Now, you've got two options when your mortgage comes up for renewal. You can either stay with your existing lender or you can move to a different lender entirely. There's various reasons why you might want to choose one over the other, but I'm just going to summarise some of the key reasons. Staying with the existing lender is far easier. There is no financial underwriting, often no need for evaluation, and there's no solicitor involvement. You simply look at the deals your lender has to offer, and if you like the look of them and they're the most competitive, then you select one of those deals and that will just change over after your existing deal finishes. Remortgaging to another lender, however, requires a bit more effort, shall we say, but there are reasons why you may want to do that. The first one is the most obvious, I think, and that's if the rate is better. If the rate and fees, when taken into consideration, because don't forget that can make a difference, when that is better than what your existing lender is offering you, it may well make sense to change lenders. Now, because this is a brand new application, you will need to go through the underwriting process. Payslips, bank statements, etc. will be requested. The lender will probably go and value your property, either physically or using online resources, and you will have a solicitor involved. Now, usually, the solicitor and the surveyor for the valuation are paid for by your new lender, but not always, so do take care on that point. Usually, when you're remortgaging to another lender, you do have a few more options as well. This isn't always the case, because sometimes your existing lender will allow you to borrow more if they allow a further advance, but if they won't, you might be remortgaging to borrow more should you need it. Sometimes your existing lender allows you to extend or reduce your mortgage term, but again, if they don't, you can do that on a remortgage typically. So there are various reasons why you might want to remortgage outside of just literally looking at the rate. Now, if that is either, frankly, too much effort, and I completely get that in today's modern world, and you simply don't want to do it, then some people prefer to stay with their existing lender, even if they're not the very most competitive option, but because it's the simplest option. So there's a lot to weigh up when your rate comes to an end. Don't just leave it to go onto the variable rate, because that can often cost you a lot more money in comparison to another fixed rate or another tracker product. But if you're in doubt about what to do when your rate comes to an end, talk to an expert like ourselves and we will happily guide you through the options.